Right now, a massive chunk of investors are spinning their wheels, not because the market is failing them, not because they picked the wrong fund, because they're operating beneath a number no one ever bothered to tell them about. And until they get above it, compound interest is basically sitting on the sidelines doing nothing for them. There's a specific dollar amount you need to be putting into the market every single month before compounding actually starts reshaping your financial life in any meaningful way. Below that figure, you're doing everything right. You're showing up consistently. You're staying disciplined. You're not dumping your holdings every time the market dips. And yet, a decade later, your account still looks almost identical to a basic savings account. Today, I'm going to show you exactly what that number is, break down precisely why it exists, and walk you through the math so clearly that you'll never look at your investment strategy the same way again. Here's the thing nobody mentions when they pull up those famous compound interest charts. You know the ones. The line starts out flat, curves upward gradually, and then somewhere around the 20-year mark, it just launches into the stratosphere, turning a modest monthly deposit into hundreds of thousands of dollars. Those charts are accurate. The math checks out. But those charts are doing something very deliberate that makes them nearly useless for the average person trying to apply them to their own situation. They bury the threshold. There's a point, a specific, calculable point, below which compounding is essentially invisible in your actual financial life. Your returns are technically accumulating. The interest is technically compounding, but the output is so small that your brain correctly reads it as, this isn't working. And that's where things get dangerous. Because when that feeling hits, and it hits almost every investor somewhere in the first few years, people draw the wrong conclusion. They tell themselves the problem is the market, or the fund, or the strategy. So they make a move. They start chasing something with a better story. They redirect their money toward whatever seems more exciting, and they make their situation significantly worse. The real issue isn't any of those things. The real issue is that they're below the threshold. And until you know what that threshold is and why it exists, you can't make the right call about what to do next. So let's put real numbers on this, because vague explanations don't help anyone. According to S&P Global and data compiled through 2025, the S&P 500 has delivered an average annual return of roughly 10.2% over the past century. Adjusted for inflation, that figure drops to around 7%. And as recently as March 2026, Fidelity confirmed the 40-year average sits at 11.5% annually. For every calculation in this video, I'm going to use 8%. That's conservative. That's grounded in reality. That's not a best-case number dressed up to make a chart look impressive. It's the kind of return you can reasonably expect from a diversified, low-cost index fund over the long haul, rough patches included. Now watch what happens at different contribution levels. At $50 a month, investing at an 8% annual return, after one full year, you've earned roughly $5 in returns. $5. After 5 years, your account holds approximately $37. Of that, you personally contributed $3,000. Compounding added $700. After 10 full years of never missing a single payment, your balance sits at roughly $9,200. Of that, close to $6,000 is money you deposited yourself. Less than $3,200 came from compounding across an entire decade. Now here's the number that flips everything. After 30 years of perfect unbroken discipline at $50 a month, your account holds roughly $74,500. The average American household spent just over $77,000 per year in 2024, according to the Bureau of Labor Statistics. 3 decades of iron discipline cannot cover a single year of average living expenses. That's not a failure of character. It's not a failure of strategy. It's a threshold problem. And today we're going to find exactly where that threshold lives. The turbocharger analogy. Think about compound interest the way an engineer thinks about a turbocharger. A turbocharger takes the exhaust an engine produces, the waste energy, the byproduct of combustion, and uses it to spin a turbine that compresses incoming air and forces it back through the engine for another pass at generating power. The waste becomes fuel, output becomes input, the system feeds itself. You recognize this. It's a feedback loop where growth generates more growth. That's exactly what compound interest does. But here's what most people have never been told about turbos. They don't function at low RPM. Below a certain engine speed, there isn't enough exhaust pressure to spin the turbine. The turbo is physically right there, bolted to the engine, an actual component of the system. But it isn't doing anything you can feel. Every bit of power at low RPM comes purely from what you put directly into the engine. Nothing extra, nothing more. Then at a specific threshold, everything shifts. The boost activates. The engine starts producing dramatically more than the fuel input alone should allow. The feedback loop has kicked in. Your investment portfolio works the exact same way. Before your balance reaches a certain size, you are the engine. Your monthly contribution is the combustion. Your returns are technically cycling back and compounding, but there isn't enough pressure to spin anything meaningful in your actual financial life. The turbo is there. It's running. But below the threshold, you're supplying all the power yourself, manually, every single month. The point where that changes, where compounding starts doing more work than your own contributions, tends to fall somewhere between $100,000 and $150,000 in total invested assets. I'll show you exactly why in a moment. Everything you do in what I call phase 1 of your investment journey, earning more, trimming unnecessary spending, redirecting raises, funneling any extra income toward the market, serves one single goal: getting the pile large enough for the percentage to matter. Before the boost kicks in, contributions are the strategy. Compounding is the reward you collect afterward. The phase transition in hard numbers. Here's the comparison those polished charts always hide from you. Same 8% return, same time frames. The only variable is how much goes in each month. At $50 a month, 10 years gives you $9,200. 20 years gives you $29,500. 30 years gives you $74,500. At $200 a month, 10 years gives you $36,800. 20 years gives you $117,800. 30 years gives you $298,000. At $500 a month, 10 years gives you $91,500. 20 years gives you $294,000. 30 years gives you $745,000. The interest rate is identical. The time frame is identical. The only variable is the monthly deposit, and the 30-year outcome moves from $74,500 to $745,000, a 10-to-1 difference, purely from changing what goes in each month. But here's the number buried inside that table that actually matters most. At $50 a month, your portfolio never crosses $100,000. Not in 20 years, not in 30. You spend your entire investing lifetime stuck in phase 1. The turbo never reaches the RPM needed to engage. You grind through 3 full decades and never arrive in boost. At $200 a month, you cross $100,000 around year 22. You get roughly 8 years of phase 2 compounding before the 30-year mark. At $500 a month, you cross $100,000 around year 11. After that crossing, compounding starts visibly outpacing your own contributions every single month. You get 19 full years of phase 2 compounding before you hit 30 years. That's why the terminal balance difference isn't linear. It's not simply that $500 is 10 times $50, so the result is 10 times bigger. It's because the investor at $500 a month crosses the threshold nearly 2 decades earlier and gets almost 2.5 times as many years of turbocharged growth. The math compounds the advantage the same way it compounds the money. What crossing the threshold actually feels like. The 8% annual return on $10,000 is $800 a year, about $67 a month. That's a tank of gas in 2026. It doesn't move the needle on your financial picture. The 8% annual return on $100,000 is $8,000 a year. That's $667 every single month, generated without working, without trading, without making a single decision. That's real monthly income from doing nothing except staying invested. The 8% annual return on $500,000 is $40,000 a year. That's $3,333 a month. That's retirement income. That's financial independence. That's a completely different life than the one your $50 a month account will produce. Same percentage rate. Completely different life. The only variable is the size of the pile. Phase 1 is pile building. The percentage is background noise until the pile is large enough for that percentage to generate output you can actually feel. The mistake that feels like the right move. Here's the expensive part. The part most financial content never addresses clearly. When most investors hit the phase 1 feeling, that dull frustration of checking a balance after years of consistent investing and seeing underwhelming numbers, they make the same diagnosis. Almost always, the conclusion is, my return rate is too low. So they start chasing. This is the most common and most costly investing mistake. And it feels completely rational from the inside. Something feels off. I need to change something. Let me adjust the thing that seems most directly connected to the output. The return rate seems most connected to the output. So change that. But the diagnosis is wrong. Let me prove it with numbers, because this is the kind of claim that collapses without them. $200 a month at 8% for 10 years gives you $36,800. Now suppose you somehow double your annual return from 8% to 16% consistently for 10 full years. This is a performance level that almost no institutional fund manager on earth sustains over a decade. At 16%, your $200 a month for 10 years produces approximately $52,200. That's $15,400 more than the 8% result. Sounds significant, until you think about what sustaining 16% annually actually demands in real behavioral terms. You're absorbing the kind of volatility that drops your portfolio 40 to 50% in bad years. You've almost certainly abandoned a boring diversified index fund. You're making active decisions, probably individual stock picks, probably concentrated bets. And here's what the data says about what happens when real people try this. Dalbar, the financial analytics firm that has tracked actual investor behavior since 1994, released their 2025 quantitative analysis of investor behavior, showing that for the year ending December 2024, the average equity investor earned 16.54%, while the S&P 500 returned 25.02%. an 8.48 percentage point gap, the second largest investor underperformance gap in a decade. Dalbar also found that investors guessed correctly on market timing just 25% of the time in 2024. 1 in 4. That's the actual success rate of active market decisions by real investors with real money and real emotions involved. The theoretical 16% return almost never materializes as a real human holding. What you actually get is something closer to 8 or 9%, delivered through several genuinely traumatic portfolio drops that most people cannot emotionally survive without selling at exactly the wrong moment. Now, instead of chasing returns, what if you simply increased your monthly contribution from $200 to $350? Same boring 8%, same 10-year window, same index fund you already own. $350 a month for 10 years at 8% produces approximately $64,000. That's more money, less risk, zero panic decisions, no tax events from selling, no trading costs, and the contribution increase beats return chasing every single time when your balance is small. Not as a philosophy, as pure arithmetic. Why no one says this clearly? The reason financial media almost never makes this argument is structural. There's no product attached to increase your contribution to a boring index fund. A brokerage account you add money to and never touch generates almost nothing in trading fees, advisory revenue, or fund management income. Complex strategies, active fund selection, premium market timing tools, specialized ETFs, those are monetizable. Boring contribution discipline is not. Your return rate is the interesting number. It generates articles, comparison tools, heated comment sections. In phase 1, it barely moves your outcome. The lever that actually drives your results in phase 1 isn't the market. It's the monthly deposit, the hidden fee damage. Before we move on, here's one more way phase 1 investors get hurt without realizing it. A 1% annual advisory fee on a portfolio earning 8% before fees leaves you earning 7% after. That sounds small. Over 30 years, a 100,000 portfolio at 8% grows to approximately $1,006,000. At 7%, it grows to $761,000. The fee costs you $245,000 in compounded returns. The truly dangerous part? In phase 1, when your account holds $18,000 and the annual fee is $180, it looks trivial. It only registers as catastrophic when you're deep in phase 2 doing the math backward. By then, the damage has already been accumulating for years. The behavioral science behind why you might quit. There's a deeper layer here worth understanding. Richard Thaler, behavioral economist and Nobel laureate who won the prize in 2017 for his work on human decision-making, documented what he called the feedback gap in financial motivation. Humans continue behaviors when they see visible results. They abandon behaviors that appear to produce nothing. Compound interest in phase 1 generates returns so small that they fall below what Thaler called the perceptual threshold, the minimum output level the human brain registers as meaningful progress. Your brain reads, not working. The accurate reading is working exactly as designed at a scale too small to feel yet. That gap between the mathematical reality and the lived experience is where the most expensive financial decision of your life gets made. Not panic selling, though panic selling is costly. The most expensive phase 1 mistake is the strategy switch. You correctly identify that something feels wrong, you incorrectly identify what it is. You move from an index fund into individual stocks. You redirect months of contributions into something speculative. You subscribe to a premium stock picking platform, and now you're not doing phase 1 investing anymore. You're trading. Completely different activity, completely different historical odds. Terrence Odian and Brad Barber at UC Berkeley published research in the Journal of Finance tracking 66,000 individual brokerage accounts over 6 years. Their key finding: the most active traders earned average annual returns of 11.4% during a period when the market returned 17.9%. A 6.5% annual underperformance driven primarily by trading costs and the behavioral tendency to buy in after the big move had already happened. The least active accounts nearly matched the market return exactly. Doing nothing in phase 1 is not passive failure. It is the statistically optimal decision. The problem is that it doesn't look like a decision. It looks like waiting. And waiting feels like you're not doing anything about the problem. Here's the number at the center of everything I've been building toward. Most financial calculators, most personal finance advice you've ever encountered, treats your monthly investment as one fixed input. But there's a second variable that matters just as much, and almost nobody talks about it. The year you cross the threshold. Every investor has a calculable date, a specific month in their investing life when the returns generated by their portfolio start to exceed what they're contributing in new money each month. That is the phase transition. Before it, you're building the pile. After it, the pile builds itself, and you're along for the ride. The difference in your final balance between crossing that threshold at age 45 versus age 52 is not small. It's not 10 or 15% more. At typical market returns, every year you cross the threshold earlier adds approximately 12 to 18% more to your terminal balance at retirement, depending on your starting conditions. 2 years of earlier crossing can represent $80,000 to $120,000 of additional wealth at retirement for someone on a typical middle-income investing trajectory. Not from any complex strategy, just from crossing the line sooner. This is why your earliest investing dollars are the most powerful ones you'll ever put in. A dollar invested in month 1 of your portfolio at 8% annual returns becomes approximately 10/60 after 30 years. That same dollar invested in year 25 of your portfolio compounds for 5 remaining years and becomes approximately $147. Your earliest dollars are worth more than 7 times your later dollars in pure compounding power. Every month you stay below the threshold. Every raise your lifestyle absorbs before you redirect it. You're not losing small amounts of money. You're sacrificing the most powerful compounding dollars in your entire portfolio. The ones with the longest runway. The ones that compound for 30 years instead of 5. Start small was never meant to mean stay small forever. It meant lower the activation energy to begin. Open the account, build the habit. And then, as early in the journey as possible, grow the number. Because the early years are where your most powerful dollars live. Let me bring all of this together. There are 2 completely distinct phases of building wealth through investing. Phase 1 is pile building. In this phase, your monthly contribution is the primary engine. Your return rate barely matters. The one job you have in phase 1 is to cross the threshold, to get your invested assets past the $100,000 to $150,000 mark as fast as your life allows. Every dollar you redirect toward contributions in phase 1 is doing more work than almost any return optimization strategy could ever do. Phase 2 is what everybody imagines when they picture compound interest. The returns start to exceed your contributions. The pile grows on its own momentum. Your monthly deposit still helps, but the math is doing the heavy lifting now. The mistake almost every phase 1 investor makes is diagnosing a return rate problem, when the real issue is a contribution level problem. They start chasing. They take on more risk, make more trades, and underperform the market by an average of more than 8 percentage points in a given year, according to Dalbar's most recent data, for the privilege of working harder and worrying more. Here's what actually moves your outcome. First, right-size your contribution today. The most common reason people invest less than they should is institutional inertia, not inability. They set up automatic contributions when they opened the account and never went back to update them. Log in this week and increase your monthly contribution by $50. Not a complete budget overhaul. One login, one change. Over 20 years at 8%, that extra $50 a month compounds to approximately $29,400 from a single 15-minute decision. Second, redirect income growth before your lifestyle claims it. Raises happen, bonuses happen, tax refunds. In nearly every case, within 90 days of receiving more income, the lifestyle has absorbed it, not through deliberate choices. The money just diffuses into slightly more comfortable habits and no one consciously decided to spend it. The rule that actually works. Redirect at least 50% of every net income increase directly into investments the same day it arrives. Your lifestyle still improves on the other 50%. Your threshold date moves forward. Both things happen at once. Third, pre-decide your next life event. When does your next car loan end? Your student loan? When is your next bonus? Write the approximate date down right now. Write the amount. Write the specific percentage you'll redirect to investments the moment it lands. Make this decision while there's no money in your hand yet, because the decision made in the abstract today is the one that executes correctly. The decision made while holding actual cash and standing near something you could spend it on almost never ends up going to investments. If you want to see what your actual threshold date looks like based on your current numbers, watch the next video on screen. This content is for educational purposes only, and I'm not a financial advisor. Any results depend entirely on your own decisions and actions.